welcome and thanks for joining us. I know you're busy, but I promise this is going to be worth your time. Today, we're talking with Dr. Mark Soth about the tax implications of withdrawing money from your corporation. Now, Dr. Soth is an actual doctor. He's an ICU doctor at a major Canadian teaching hospital, but he's also a self-described finance nerd, and that's the reason he's joining us today. He hosts the website loonydoctor.ca, where he empowers people to take control of their financial health through his ever-growing library of educational material. A few housekeeping items before we get going. Please note that this presentation is for educational purposes only and is not intended to provide legal, tax, or accounting advice. National Bank Financial is not a tax advisor, and clients should seek professional advice on tax-related matters. Any investments or strategies mentioned today are not necessarily suitable for all types of investors. This presentation should not be considered a recommendation. And finally, the Christianson Wealth Advisor team is affiliated with National Bank Financial Wealth Management, a division of National Bank Financial, which is a wholly owned subsidiary of the National Bank of Canada. The opinions expressed here do not necessarily reflect those of National Bank of Canada or its subsidiaries. So, Dr. Soth, thank you so much for joining us. I'll pass it over to you and leave our viewers in your caring hands.
Thank you so much for having me. I was very excited to come here and be invited to speak with you about this. And, this is an area that I'm passionate about, is trying to help colleagues. And there's lots of high income professionals and business owners out there to basically do the best that they can with their money. And one of the parts of that is how to use a corporation if you're using one. So I was excited about the topic you asked me to speak about, because it means you're thinking about some of these issues. And it's one of those things that on the client end of the discussion, understanding some of this is really important to actually get the most out of your advisors and optimize your situation. You have to participate in the whole process. So I have the same disclaimer. I am a physician. I'm not an accountant or a financial advisor. So I'm not going to give specific financial or accounting type of advice. But I want to try to teach you some of the material that you can understand that'll help you have those discussions with the other team members that you work with. So today I want to talk just a little bit about corporate tax deferral, a bit about corporate investment taxation, refundable dividend taxes, the capital dividend account, and peppered throughout this, which can be kind of technical, thick material. I've really tried to distill it down to some important planning considerations and things that you need to think about in having these discussions from a very practical standpoint. And the reason this whole topic comes up is as a small business owner or an incorporated professional, our money flows like a river. And for the average person, it's relatively steady. But for us, we can have years where we have tons of cash flow coming through. It can overflow the banks of our river. And a lot of that overflow is going to be lost to taxes because of our progressive taxation system. And the surrounding soil is like cracked and parched. There's a never-ending desire, a need for more of that tax money. So it's not like we get that back in the other years where our cash flow may dry up. So that's where a corporation becomes really, really useful. It helps us to regulate that cash flow so that we don't have years of overflowing and paying more tax than we need to, and then other years where we don't get to make that up. So the way that a corporation works, it's basically like a big reservoir. So all of your business income goes into the corporation, your business expenses flow to that, and you have this pool of money that's there. And that pool of money is taxed at a lighter tax rate. It's either going to be the small business tax rate or the general corporate tax rate. So somewhere between 10 or 11%, and at the higher tax rate around 27%. So much lower than what you'd pay for personal taxes. Now, you do pay personal taxes to spend the money. You have to flow that money out of the corporation, and that's where the rest of the money gets paid to you, and the rest of the taxes get paid at the same time. And the idea is that as the money flows through completely, the amount of tax should be similar to if you'd earned it on your own. But what this does is it helps you to smooth that out so that you can release it more gradually and keep yourself in lower tax brackets over time. Now, what we're going to talk a bit about today is how do we actually flow that money out? And there's different ways that we can do that to regulate these floodgates. So the most common way that people are probably familiar with is salary. So when you pay yourself a salary from your corporation, You're going to pay, it's going to be T4 income. There'll be Canada Pension Plan contributions, and it's all deductible against the company's income. So the company pays no tax on money that you flow through a salary, but you pay regular personal tax like everybody else would. Now, the other type of money you can float is dividends. And dividends will have been partially taxed within the corporation. So the business income is going to be taxed either at the high general corporate tax rate, in which case you could pay yourself eligible dividends, or if the corporation is paying tax at the lower small business tax rate, then you would be able to pay out whatever is left over as non-eligible dividends. And the eligible dividend tax rate is going to be a bit lower than your regular income tax to account for the fact that the corporation has already paid taxes at a higher rate. And then the non-eligible dividends, there'll be a little bit more of a tax rate than the eligible dividends because the corporation paid slightly less tax. Now, when you add those together, it should be very similar to what you would have paid a salary. And that's what's called tax integration, which is one of the cornerstones of our taxation system, where the idea is that money that you earn, whether it's flowed through a corporation or earned directly personally, should be paying the same amount of tax. Now, it doesn't work perfectly, and it generally doesn't actually favor corporations, but it's pretty close. Now, there's other ways that we can flow money out of our corporation. One would be using capital dividends. So along this idea of tax integration, if I were to earn a capital gain personally, only half of that capital gain would be taxed, the other half would be excluded. And the same thing happens in a corporation. If the corporation earns a capital gain, that excluded half, which you don't have to pay tax on, can be flowed out to you without tax on it as well as a capital dividend. So it's a tax-free capital dividend that comes out. The other taxed part would be taxed normally. And we can have ways of flowing money back and forth over short periods of time, like one fiscal year, complete fiscal year, plus part of another fiscal year using shareholder loans. So you can't have it sit around for more than one tax filing of the corporation, but you can loan money to your corporation or take money from your corporation as a loan on a short-term basis. So I mentioned that tax integration does not favor corporations. So why then would anybody want to use one? Well, one of the biggest reasons is what's called the tax deferral advantage. So what I'm doing with tax deferral is I'm deferring tax that I would pay now at presumably a very high tax rate into the future, and hopefully pay the tax later on, which later is usually better than now, but also at a lower tax rate in the future. Now, the penultimate example of that is actually an RRSP, not a corporation. So the RRSP shown in this model here is the green line. And with an RRSP, you get a dollar for dollar deduction against your income. So it's going to be 100% pre-tax money. So if I have $10,000 of income that I want to invest, and I invested in my RRSP, I have $10,000 to invest. There's no tax taken away from that. Now, a corporation is going to have partial tax deferral. So here I've got the light blue line, which would be the small business tax rate around 12%, which leaves me 88% of the money, and or in this case, about $9,000 to invest. And a general corporate tax rate, which would be if I have corporate income above that limit of about $500,000, then it gets taxed at a higher rate, usually around 26, 27% on average across the country. But that still leaves you much more money than if you were to pay the full top marginal personal tax rate. So because you have more of this capital initially to invest, over time, when it compounds, since it's starting from a larger amount of money, it's going to compound into a larger amount of money over a long time period. So you can see the RRSP compounds more, then next to be a corporation, a general corporation, and then if you took that tax hit up front, you'd have less. Now, one thing that people forget is this is tax deferral. It's not tax elimination. And you still have to pay tax on the money to get it into your personal hands and be able to actually spend it. And if you were to take it out and pay tax at the same tax rate as you deferred the tax from, it actually ends up being exactly the same amount. And when you do that with these types of accounts, you can see the lines come back to converge to be very similar to each other when you account for taking the taxes out to access it. So tax deferral does not necessarily equal tax reduction. And tax reduction is really what we're ultimately looking for. It can equal tax reduction. So if I were to contribute in a high tax bracket, in this model here, what I've done is I've modeled a balanced portfolio or fairly aggressive portfolio. But if you contribute and defer the taxes from a high tax bracket and then access it later in a low tax bracket, you can see that the money grows. And then when you access it, because you're in a lower tax bracket from where you deferred it from, you have more money in your hands afterwards than you would have if you had just taken the tax hit up front at that high tax rate and invested it personally, which is the red line. And then you would have more money because you're deferring tax from a high rate now and paying the tax later at a low rate. So tax deferral can be tax reduction if you're making that shift over time. And that's what works for most people, because we have our high income years while we're earning and accumulating. And then during retirement, presumably, we are taking out money at a lower and slower rate and paying less tax on it because we're in a lower tax bracket. So tax deferral generally works out to quite well for the average person. Now, the opposite can apply, though. So if I were to defer tax now at a very low rate and then take it out later in the future at a very high rate, I'm actually going to have less money afterwards. So here I've got that green line, which is an RRSP, which is 100% tax deferral, corporations, which are partial tax deferral, and the baseline would be the top personal tax rate, which is the orange line. And yes, the amount of money looks like I have more, but then after I take it out and pay the taxes on it, when I'm paying that at a higher tax rate, I actually have less money in my hands afterwards. So that can happen too. It's less common. But the idea there is to remember that when you're using a corporation or an RRSP, the money has to come out sometime. And with a corporation, you have a lot of control over when the money comes out. That's how you can regulate those floodgates. And if you are only taking very, very, very small amounts out now and building a really huge corporation, eventually that money is going to have to come out. And if you're taking it out now in a low tax bracket and deferring it to later on and are forced to take it out at a high tax bracket eventually, then you may actually make things worse. It's less common, but it can happen for people that have very high incomes and very low spending. So there's some really important practical planning implications that go with that. One is that, the money needs to come out sometime. And what you want to do is you want to smooth your cash flow out of the corporation or your RRSPs, whichever you're using, or both usually. And that requires some long-term modeling about your current and your future income and spending. So you want to try to smooth that out. And that's going to require for you to tell your advisors about what you think is going to be happening with your spending and your earning over time, both now and in retirement, if you're thinking about the long term, but also in the short term as well. So if you're going to have some chunky spends like real estate or vehicles, things like that, where you're going to have big lumps of money, then you want to be able to smooth that coming out of the corporation and not just do it in big lumps if you can, because the more you do it in big lumps, the more you're going to lose to taxes. So that income smoothing is important, and that requires discussion. So the other part about moving money out of a corporation efficiently over time is to understand how it is taxed and how the tax system works with a corporation. So to understand that, you have to understand what the different pools and reservoirs of money are within the big corporate reservoir that you've got. So most of us would be familiar with, our bank account for the corporation. So we'd have an operational account where business income comes in, we pay our expenses out of it. And then once a year, when we do our tax filing, we look at our active business income from that, pay our corporate tax bill. We may have a line of credit associated with it to help smooth some of the cash flow bumps, or a high interest savings account. But these are all real bank accounts. They've got real dollars in them. And that's what we use to run our business from. Now, if we're running our business and we have some extra money that we don't need to use right now, this is where having a corporation becomes powerful, in the sense that you can take some of that partially taxed corporate money and invest it. So you'd have a corporate investment account where you would invest within the corporation. Now, that's going to be a larger chunk of money than you would have if you just paid personal tax and then invested it on your own, usually because of the corporate tax rates are being low up front. But to prevent us from having an advantage with the corporation, there's tax rules in place. So when you have an investment account with your corporation and you earn passive business income, then that passive income is taxed at a high rate up front. It's taxed about 50% for interest and foreign dividends up front, and it's taxed at about 38% for eligible dividends. So pretty close to an approximation of the highest personal tax bracket. And they do that to prevent us from having too much of a tax deferral advantage with the corporation. Now, the good news is that's not the end of the story. Now, the part of this tax integration means that they just can't tax us the highest rate up front, and that's it. It has to try to be similar to what you would be doing on your own. And that's where these notional accounts come into. And notional accounts are accounts that are tracked for the purposes of your taxes, your corporate taxes. They exist on paper for corporate tax filing, but it is actually real money because it can mean corporate tax refunds. It can mean paying out more tax efficient dividends to yourself. So real money is at stake. So it's really actually important to understand how they work. But they exist as kind of a theoretical thing for taxes. And there's a few big ones, which we're going to talk about. There's RDTOH, which is the refundable dividend tax on hand. So when you pay out dividends from your corporation, and you'd had tax on passive income, some of that tax is refundable, and it's refundable dividend tax on hand that gets refunded back to the corporation when you pay out personal dividends and then pay personal taxes on that. There's also the general rate income pool, which is called GRIP, and that's your corporation's ability to pay out eligible dividends to yourself. So eligible dividends have a lower personal tax rate, and that's to reflect the fact that prior to that money coming to you, some corporation has paid taxes at the general corporate tax rate. So that could have been a bank or some other company you were investing in that paid you Canadian eligible dividends, or it could be that your own corporation made income above the small business deduction and paid general corporate tax rates on some of its income. Both of those ways can add to this GRIP pool and allow us to pay ourselves these tax advantaged eligible dividends. And the third big account, which I think is probably the most powerful one, is your capital dividend account, or CDA. And that account tracks the non-taxable half of a capital gain and allows you to pay that out using a special election as a tax-free capital dividend. So it's a really, really powerful way to move money out of your corporation tax efficiently. And this is important to keep all of this money moving out as efficiently as you can, not only to minimize the taxes that you're paying now, but the larger and larger you grow your corporation, the bigger the tax liability grows in it too. And all that money has to come out sometime. So you're better off to be paying attention and keeping that money flowing rather than let it sit there and stagnate. And I know you folks are in Manitoba. I grew up in Northern Ontario, so I know what happens with stagnant water. You get mosquitoes, right? And the mosquitoes will suck the blood out of your corporation, the tax skeeters. So you want to keep that money flowing to keep the tax skeeters from growing in your corporate reservoir. So I'm going to go through each of those notional accounts in some more detail because they're really important to be aware of because it affects how you pay yourself and it can affect your corporate tax efficiency. And if you don't understand about it, you won't ask some of the right questions. So before I do that, just to come back to the high level idea of how this works, you earn income. It's business income. It gets that low corporate tax rate, which leaves you more money in this corporate reservoir to operate your business and to invest excess. The investment income is taxed at a high rate up front, and then some of that tax gets refunded back to the corporation when you flow dividends out to yourself and pay the personal tax. And if you add up along the way, the taxes should be somewhat similar to as if you just earn the money directly. But it goes through this process, and the big advantage here is this tax deferral as long as you can keep that corporate reservoir flowing and efficient. So the first part of that is to understand refundable dividend tax on hand, or RDTOH. So the way that this works, and I'm going to do it for eligible dividends and for interest as examples, because there's two types of refundable dividend tax on hand. One is ERDTOH, which is associated with eligible dividends. So eligible dividends are paid out by either a public Canadian public company, or even a private company that has income at the higher than the small business rate, with the general corporate tax rate. So let's say my corporation has some investments and my corporation gets $10,000 of eligible dividends. Well, that's going to be taxed up front at 38%. So $3,800 in corporate income tax is going to be paid or due right up front. But $3,800 is also taxed by this eligible refundable dividend tax on hand, or ERDTOH account. And what happens is when I flow out a dividend, and I'm allowed to flow out an eligible dividend dollar for dollar from what I received. So I received $10,000 in eligible dividends. I can pay out $10,000 of eligible dividend. I'm going to pay personal income tax on that, but my corporation is also going to get that ERDTOH refunded to it. So I pay personal tax on my eligible dividend. The corporation gets the tax that it paid fully refunded. So what happens in this case is there's a net of zero corporate tax that's paid, and your net personal tax is going to be whatever tax bracket you're in, but I use the highest personal tax bracket for Manitoba in this case, which comes out to 37.78% for eligible dividends. And in this case, tax integration works perfectly. You would have paid 37.78% tax if you'd taken the eligible dividend directly from your own personal investing. And when you add up the corporate and personal taxes from flowing it through a corporation, it comes out to exactly the same thing. So this is tax integration working as intended. Now with interest income, it doesn't work quite as well. So interest income, in this case, we'll say we're going to have $10,000 of interest income received either from bonds, or it could be foreign dividends. There's other, although that adds in some other complications, but this would be other investment income. It's taxed at the highest rate up front, about 50%. And when that happens, 31% or 30.67% technically, or around $3,000 goes into this non-refundable RDTOH account. So NRDTOH. And when you pay out $8,000 of non-eligible dividends, because you're not able to use this to pay eligible dividends, you pay out non-eligible dividends, you release this non-eligible refundable tax. And that would release $3,000 back to the corporation. And of course, you have to pay taxes on that $8,000 of non-eligible dividends as that money's flowed through. And you'll have paid some corporate tax and some personal tax. And in this case, the net corporate tax would be about 20%. So you paid that 50% tax rate up front, you got a 30% refund. Net corporate tax is around 20%. And then on that 80% that's left over, which is the $8,000 in our example, you're going to pay non-eligible dividend tax rates on. So 0.8 times 46.67% in the highest tax bracket, that comes out to 37.33%. Now, when you add that together, 20% plus 37.33%, that's a total tax bill of your corporation and you personally of 57.33%. And that's much higher than the highest personal tax bracket of 50.40%. So this is what I'm saying when I say that investment income flowing through a corporation actually is not by itself an advantage. It's actually there's more tax on the flow through. The advantage of using a corporation is tax deferral, where you can defer tax from a high tax bracket now and take it out at a lower tax bracket in the future. And that's why managing this flow through a corporation is so important. So when you see that you have some refundable dividend tax on hand, and this would be something that you'd sort out through your account, you want to use some dividends as part of your compensation. So I just want to illustrate that when you do have refundable dividend tax balance and you have to pay yourself something, and your choice is going to be, do I pay myself salary? Do I pay myself dividends? Do I pay myself a mix of salary and dividends? Well, you want to make sure that when you have refundable dividend taxes, you're paying enough dividends to release it, even if that's at the expense of salary. So here's an example at the top. Let's say I've got $3,067 of NRDTOH in my corporate notional account that's tracked for taxes, and I'm going to pay myself salary in the lowest tax bracket. Well, salary does not release refundable dividend taxes. So let's say I paid myself $8,000 worth of salary. I'd pay about $2,000 of tax in the lowest tax bracket, and that would be the total amount of tax that I've paid is this $2,064. Now, let's say I'm using a dividend to pay myself, and I'm in the top personal tax bracket, and I've got this refundable dividend tax balance that's sitting there. Well, I'm going to pay myself an $8,000 non-eligible dividend. And because I'm in the highest personal tax bracket, I'm going to pay $37,000 in tax, $3,700 in tax roughly. But I'm also going to get this $3,067 corporate refund. So when you add up the amount of tax that I've paid personally and the amount of tax that got refunded to my corporation, the total amount of tax there in that 1 year is going to be less, $666. Now, let's say, just to compare it to the lowest tax bracket, well, if I did the same thing with dividends in the lowest tax bracket, the refund to the corporation of $3,000 is more than the $1,500 of personal tax that I would have paid. So the net of my personal taxes and my corporate taxes is actually less by paying dividends. I actually get more refund to my corporation than because the corporation had that tax collected up front. So one important caveat when I'm saying this is if you have refundable dividend tax in your corporate accounts tracking. If you don't, salary is more efficient than dividends. Salary, with tax integration, salary works out to be more tax efficient than dividends do. However, the exception to that is if you have a refundable dividend tax balance. In that case, if you have that notional account balance, releasing that trapped money is going to offset any tax advantages that you might have with salary. So what are the planning implications of that? One would be find out if you have eligible or non-eligible refundable dividend tax balances. And you'd ask your accountant about that. You can find it on your corporate tax return. It's not easy to spot and understand what it's actually saying. So the quickest way is actually to ask your accountant. And this is part of what you should be planning. So as you develop more corporate investment income, you may be paying some dividends rather than just paying salary because you want to release that refundable dividend tax on hand. And the way this pans out over your career is going to change. It's not that you just set your salary or your dividends and just keep that static for your whole life. What you want to do is you want to start off with salary earlier on in your career because that's the most tax efficient. It gives you RRSP room, which is a tax shelter. It's going to be more efficient that way than dividends are on their own. However, as you start to get more investment income in your corporation, you would start switching to using more and more dividends and less salary, potentially, if you're not spending a lot of money to compensate yourself with. So this is what I would call a dynamic salary type of strategy, where you pay enough dividends to release the refundable dividend taxes, and then make up whatever the difference is with salary. And at the beginning of your career, it's going to be mostly salary, and you're gradually going to transition over to dividends as you get older. And one of the questions, the bonus questions that I got just before the talk was asking about RRSPs and corporations. So I'm actually going to show an example of what I'm talking about at the end of the talk as well. But the important thing for you to know is to make sure you discuss your spending plan and your anticipated investment income with your advisors and your accountant, because those two things have to be meshed together. And that's difficult because accountants and financial advisors are different people usually, right? So you have to make sure that there's that link there, that both parts are meshing together. And the other thing that people don't realize is sometimes it could actually make sense to pay extra dividends, even if you don't need the money personally right this second. If you're going to get a larger corporate refund than the personal taxes that you're going to pay, you may want to pay some extra dividends to release that refund to the corporation. And if you don't need that money personally, well, you can invest it more tax efficiently personally anyways than what is going to flow through a corporation. So there are cases where you may give yourself more dividends than what's required to live on, depending if you're in a pretty low tax bracket. The other thing I would say is if you start running into those kind of problems, then it means that you're making a lot of money and not spending a lot of money. So spending bit more to release some of those refundable taxes and take some of the money out slowly over time is also an option, because you want to smooth your consumption over your lifetime. Okay, that brings me to the next big account type, the capital dividend account. And I think this is probably the most valuable account that you've got from your notional accounts. So the way that this works is this is how capital gains get tracked passing through a corporation to maintain that tax integration. So just as an example, let's say I have a $10,000 realized capital gain. So I have a capital gain, I sell whatever it is so that I realize that capital gain, and now there's going to be taxes owed on that, right? So there's what's called a 50% exclusion rate currently, which means half of the capital gain is excluded and half of the capital gain is included. Now, the included half of that capital gain, the $5,000, is going to go through this process that we just talked about for taxing of investment income. So it would be that included half would be taxed the same way as interest. There'd be that 50% tax up front. There'd be 30% would be tracked by this NRDTOH account. And when it gets refunded, that would equal out to $1,000 worth of net corporate tax. Now, to release that tax back to the corporation, I would have had to pay out a $4,000 non-eligible dividend. There'd be about $2,000 worth of tax on that and $2,000 worth of cash left over. Now, this excluded half of the capital gain is where the CDA or capital dividend account comes into play. So that $5,000 of excluded capital gain gets tracked by the CDA. And in the CDA, what you can do is when it gets large enough that it justifies the accounting fees to file for what's called a special election for a capital dividend, and then you can pay out a tax-free capital dividend from that balance that you've got there. So if there's $5,000 in the CDA, you can pay out a $5,000 capital dividend, and that capital dividend is tax-free. It's not taxable income. So the full $5,000 will be received as cash. And when you add that together with the part that was flowed through the regular taxed part of a corporation, you get $7,000 out of that $10,000 realized capital gain. So there's some other features of that CDA that are really important to us. One is that if you're donating appreciated stock to a charity, you actually get the full capital gain added to the CDA, not just the excluded half, but the whole thing. So let's say I was really lucky and I bought a bunch of Apple stock like 20 years ago and I have this ginormous, massive capital gain sitting there. Well, that's a really big tax liability that's sitting there. It's great that I made all that money, but I'm going to have to pay taxes on it. And if I were to take some of that and donate it to a registered charity, whatever the capital gain is on the shares that I've donated, all of that capital gain goes to the capital dividend account, which means that I would be able to pay out twice as big of a tax-free capital dividend down the road compared to if I just sold it and realized the capital gain. There's other advantages to doing that too. It removes that tax liability and you get a deduction to your corporation on top of that. And that deduction can be used against any kind of corporate income. So if you have interest income in your corporation, that's a deduction against 50% tax rate. So you get massive tax break by donating appreciated stock to charities. And the CDA is really kind of what supercharges that. Another part of the CDA that's important to realize is that capital dividends are not considered taxable income. So that means they're not going to be subject to TOSI, which is the tax on split income tax rules. So if I have a non-voting shareholder spouse in my corporation who doesn't contribute over the threshold required to be able to get dividends from the corporation, if I do give them a dividend, then it gets taxed at the highest personal tax rate. But with a capital dividend, that does not happen. So I could give my spouse a $50,000 capital dividend, and there's no tax on that, and there's no triggering of split income splitting rules on that. And if they don't need that money and we don't need to live on, they can invest that money in their name. And my wife and I have been doing this for quite a while now. So my wife, who has a lower income than I do, has a very large personal taxable investment account. but because she's in a relatively low tax bracket, it's a very efficient way for us to invest. So we've not only decompressed our corporation so that we don't get into troubles with having to move large amounts of tax-laden money out later on, we've taken some of it out efficiently over time using capital dividends. And then my wife's invested that and grown that as a separate pot, more tax efficiently and with less of a tax liability embedded into it. So this is a way that you can have an income splitting strategy over a longer period of time. And the capital dividend account can help you with that. There's more ways you can do that too, but that's more than I can talk about in one talk here. Now, the one thing I would say about capital dividends is that the accountant fees will vary. So some accountants will just count it doing the special election. You can't just give yourself a capital dividend. You have to do a special election, which means that your accountant has to confirm what the balance is in your capital dividend account, and they have to fill out some special paperwork, file that with the Revenue Canada. You have to wait a couple of weeks, and then you can give the capital dividend when it's all been cleared and approved. Now, some accountants will do that just as part of the cost of doing your taxes for your corporation. That's what mine has done for these years. I'm kind of spoiled probably. Others, commonly somewhere between $500 and $1,000 would be not uncommon fees to be charged for that special election. So you'd want to have enough money in that capital dividend account to make it worthwhile if you're paying accountant fees on the other side of it. So there is a bit of a balance there. People always ask me how much would you think is worthwhile? I mean, if it's going to be, if the accountant fees are somewhere in the $500 to $1,000 range, and I've got a use for the money, I'm not just going to take it out and do nothing with it, then, $20,000 or $30,000 might be enough. It's really something that you really have to discuss with your accountant to see whether it's worthwhile to do. But again, remember, they're going to get paid a fee for doing it too. So there is a potential for bias there. A good accountant will make a good balance of those two things. The other thing to be aware of is that capital losses also subtract from the capital dividend account balance. So you need to have a positive CDA balance to be able to give a capital dividend. So if you have a bunch of losses that you've used, which you can use to write off against capital gains in terms of income tax, you also have to get that back into a positive balance overall before you can give a capital dividend. So this makes tax loss harvesting a little bit different in a corporation than it might be personally. In fact, in a corporation, you might actually consider doing something which I've called capital gains harvesting. I made that up, but it's basically the opposite of capital loss harvesting. So what you do is you have a holding with a large capital gain, you'd sell it, and then you immediately rebuy it. And there is no superficial loss rule that applies to capital gains. There's no superficial gain rule. So you can just sell it, buy exactly the same thing. There's no implications with that. You aren't missing any time in the market. The implication is, though, that you've made that a taxable capital gain now. But if we can use our capital dividend account, that's not necessarily a disadvantage. So you are going to pay some tax in the corporation, but if you are able to use that capital dividend account to pay out some money personally, the overall tax that you're paying right now might be less. And I'm going to show you exactly what I mean, because this is kind of a complicated super tax ninja move that confuses people. So let's say I've got a $10,000 capital gain that I can harvest in my corporation. So I'm going to realize that capital gain and flow it through. So I can buy and sell it. I sell and then rebuy it. I don't have to pay myself money out of my investment account. I can pay the money out of my operational account just like I would any other dividends or salary. But what happens is that capital gain gets taxed. So there's going to be a net of $1,000 tax in the corporation because of the tax minus the refund. To get that refund, I would have had to pay myself a $4,000 non-eligible dividend. I'm also going to pay myself a $5,000 capital dividend, which is tax-free. But the taxes on those non-eligible dividends are about $2,000, which leaves me $7,000. So that's the same math that I showed you a few slides ago when I showed how capital gain flows through a corporation. Now, the advantage here is if the alternative to get that money, that because you'd need that $7,000 of personal money to spend, if the alternative way of getting that personal money, $7,000, is to pay yourself either salary or dividends. And I'm just going to use salary as the illustration here. So let's say I didn't realize the capital gain, there's no corporate tax, but I want to get $7,000 into my hands. I have to pay myself about $15,000 worth of salary, $8,000 of tax at the highest tax bracket. This is using BC tax brackets. And that gives me the same amount after tax. If I looked how much money I had to pay out of my corporation, well, I had to pay $1,000 in tax and I had to pay $9,000 as my mix of dividends compared to $15,000 of salary to have the same amount of money in my hands to use. So when we're taking money out of our corporation, the start point is how much money do we need? That's what drives the decision, right? So what this shows is to get that same amount of money, you actually end up with more money left in your corporation by using a capital gains harvest and using your capital dividend account than if you're just paying yourself using salary. And if I were to compare that to non-eligible dividends, it's going to be pretty comparable, a little bit less because the tax rate on the non-eligible dividends is going to be a bit lower, but you've also would have paid some corporate tax on that business income before this. So I'm just going to finish out the CDA section with a little example about how the account moves up and down in value as things happen. So we'll start off with, you have an investment that's sold, that's got a $10,000 capital gain. The excluded half of that, or $5,000, is going to be added to your CDA balance. Losses subtract. So let's say I have an investment loss, which is a $5,000 capital loss. The excluded half of that, which is in this case can be $2,500, gets subtracted from that $5,000. So my CDA balance is now $2,500. Let's say I donate stock to a charity and that stock had a $10,000 capital gain on it. Well, that whole capital gain gets added to my CDA. So now my CDA is $12,500. That's getting to be a decent chunk of money. And if I don't have a lot of accountant fees to release that, then I might elect to have a capital dividend election. And that's going to empty out my account. I'm going to give myself $12,500 as a capital dividend, tax-free. The CDA balance, of course, then would be zero. Let's say after that happened and it was all concluded, I sold some investments, I had another loss. Half that loss gets subtracted from the CDA account. So my CDA account balance at that point would be negative $1,000. And because it's negative, I can't give any capital dividends after that until it gets added back together to be back into a positive position again. So at that point, I would need to have some gains tagged into there before I could use it again. So what are the planning implications of that? One is, I would say, find out if you have a large positive CDA balance. And I can tell you, I know people that literally have millions of dollars in their CDA balance sitting there, and they're paying themselves salary and taxed dividends every year, which is not a great idea because that CDA balance is money you could be moving out of that corporation tax-free. Unless that money has been reinvested and you can't access it because you're investing in something else, that's a way of flowing money out. And if you're flowing money out as salary or dividends, that means there is some money to be flowing out. And using the CDA balance is going to be a more efficient way of doing that. If you do have a need for a big lump sum of personal cash and you've got some large unrealized capital gains, using a capital gains harvest is one way of paying that lump sum of money out without bumping yourself up a bunch of tax brackets. And if you're using a capital dividends, it is a way that you could potentially income split with a low income spouse. It's not a subject to the TOSI rules. And if you don't need that money, they can start to grow their own investment account. And if you're charitable, donating appreciated stocks has a triple benefit. So you'd want to, if you are donating appreciated stock, you want to pick the ones that have the stock that has the largest capital gain on it from a percentage basis, and use some of that stock to make your donation with. That way you're going to get double the addition to your CDA balance, which is going to be double the amount of tax-free dividend you can give yourself down the road. It's also deductible against fully taxable income, and it removes that tax liability all at the same time. So there's three big benefits. Now, I'm just going to finish off this with saying this is not something to leave for someday. The buying power of your notional accounts erodes with inflation. So your RDTOH, your capital dividend account, those are all priced in nominal dollars, which means if they just sit there, $10,000 stays $10,000 10 years from now, even though it only buys $5,000 worth of stuff. So you're going to have to make up that difference with other taxable dividends that don't have that refund associated with it, which is less efficient. So just to illustrate this with a graph, the green line here is your capital dividend account. And the idea is how much money would you need to fund $10,000 of personal consumption from your corporation. So with the CDA, it's pretty easy to figure out. I mean, it's a tax-free dividend. So to have $10,000, I could pay $10,000 from my capital dividend account, and that would pay for my consumption. But over time, because that value becomes less, I'd have to make up the difference with other dividends. So the amount I'd have to pay out of my corporation using other dividends to supplement that capital dividend account increases over time. And that's why the green line rises, because the value of the CDA is eroding. So the CDA is your most valuable account because it's got tax-free money that can move out. Your next most valuable notional account is the ERDTOH because it's a 38% tax and a 38% refund. Next would be, and you can pay out eligible dividends to release it, which are taxed at a lower rate. NRDTOH is the next most valuable account because you get that 30% refund that's there, and you have to use non-eligible dividends, which have a bit more tax. GRIP, which is if you had GRIP or the ability to pay out eligible dividends just from having paid active business income at the general corporate tax rate, that's not quite as valuable. The main difference there is that eligible dividends are a little bit less taxed than non-eligible dividends. It's not quite as big as the refunds or the tax-free status of the other accounts is. So it's not quite as valuable, doesn't as erode as quickly. So just to summarize the big things that we've covered, corporations are for tax deferral. That's their biggest benefit. You want to smooth your income, both in the short term for your short-term spending and earning, but also for your long-term over your lifespan. So you want to be able to defer income from a high tax bracket to a low tax bracket, which means smoothing it out. It doesn't mean just blindly keeping everything in a corporation at a low tax bracket now and then taking it out at a high tax bracket later, because that could happen too. Know if you have a CDA balance, it's the most valuable notional account you've got, and you can juice it if you can, using donations of appreciated stock, or if you need some money doing capital gains harvest. But you don't want to do that unless you're going to use it. You have to use it or you're going to lose it to inflation. You want to know if you have an ERDTOH balance, and if you do, use some eligible dividends to pay yourself with it and release that refund back to your corporation. Know if you have some NRDTOH and use enough non-eligible dividends to release that back to your corporation. And you're going to have to do this in conjunction with your advisors and your accounts, because it's the investment income and the business income and how much you pay yourself and how you pay yourself. All of those factors interact together. So this needs to be a discussion that you have in planning how you're going to pay yourself over time.
Well, thank you again so much for joining us, Mark. That was an education and a half. On a personal note, I really love learning with visuals, and being cautious not to curse here, I'll say that your dam picture is going to be in my head for a long time. To everyone out there, thanks again for watching. If you're curious to learn more from Mark, check out his website at loonydoctor.ca. If you're interested in knowing how the information we covered today applies to your situation, give our team at Christianson Wealth Advisors a call. Take care.